Good evening, everyone. Thank you and welcome to another Killick & Co webinar. As the title slide mentioned, today's topic is for those who are looking to leave a lasting legacy. The webinar today will cover a few topics, but specifically we're going to focus on those who have established wealth, whose own lifestyle is comfortable and secure, and who are looking to potentially leave a lasting, meaningful legacy, whether that be to family members who will directly benefit, or to the wider society as a whole. I'm joined today by three of my colleagues. So my name is William Stevens. I'm a partner of the firm and head of financial planning. I'm joined by Peter Day, another partner of the business and head of our Hampstead office, James Gordon, an associate planning director, and Sarah Hollowell, who is our tax and trustee services director. Thank you all for joining me today. So why the webinar today? Just as a brief overview, what we've seen in the last few years has been a rising number of inheritance tax receipts collected by HMRC, an increasing number of families brought inside the scope of inheritance tax, and that's a trend that looks likely to continue to rise as thresholds remain frozen, and the value of assets, whether that through inflation or through compounding interests, continue to rise. What we want to focus on today, though, is how individuals can make the most of the assets that they do have for future beneficiaries. As I mentioned at the start, that can be individual family members or friends, or that can be for wider society as a whole. So I think probably to kick us off, we will start about when you can leave a legacy. There are two options here. There is obviously the one that comes to mind for most people, which is leaving a legacy on death through the form of a will. But there's also an ability to do it during your lifetime, making the most of the assets that you do have and being able to watch those you love enjoy the benefits of those assets whilst you're still with us. So on that topic, I guess we can move into Peter, and I can ask you the first question. You've been an advisor here at the business for 25 years, advising families across generations. What's usually the trigger for some of these conversations in your mind, and what are the pros and cons of the different approaches, whether leaving it on death or during lifetime?
Thanks, Will. Yeah, as you say, often when people are thinking about the topic of a legacy, it's naturally thinking, well, when I die, this is what I'll go and pass on to my beneficiaries, to my family, to my loved ones. But actually, for us, we find that conversation now tends to happen much more commonly at an earlier stage. And I think that's because actually many of the biggest benefits come from doing so at an earlier stage. And so we found dealing with many of the families that we look after, that's the way that they like to plan, obviously, if they can afford to. So, I mean, maybe just starting on the point you were saying, well, what are the benefits? What are the potential negatives associated with the different times and when you're making those gifts or when you're passing down those assets? And maybe, if I may, I'll start on the positive sides associated with giving away money earlier rather than at death, so during your lifetime. Why would one do that, and what are the benefits associated with it? And so from my side, a really key benefit is that you actually get to witness and, in some senses, hopefully enjoy the positive impact that your legacy is having. You've worked all your life, you've built up some wealth, and so it's nice to see that maybe in the latter years of your life, you're actually getting to see what it can do, whether that's setting up your children or your grandchildren in a lovely new home, or potentially, it seems quite a buzzword these days with VAT going on school fees, that you might be aiding with the cost of education for grandchildren or children, but you can actually see that benefit and you can see what the money that you've passed down has enabled them to do. And I think the feedback we've had from many of our clients is it can be hugely rewarding to be able to see the real benefits of the gifts they've made during their lifetime. So for us, the physical ability to see the benefits that your gift has given is hugely rewarding for many people at the latter stages in their lives, and that would encourage maybe the gifts at an earlier stage. The second point I'd like to make is that whilst it's potentially always nice to be in receipt of a legacy. In reality, it tends to have its biggest impact when it's received at a slightly earlier stage in life. Often at that stage, one's costs are at the highest level, whether it's the need to go out and buy an enlarged house if you've got an expanding family, whether again it's those costs of education, or potentially just the larger costs associated with having a young family at the stage in your life where you may be developing your career or your earnings are starting to pick up. So if you receive that inheritance at an earlier stage, it can definitely be more beneficial than maybe receiving it when you're in your 60s or 70s, and many of your largest costs have passed at that stage, and therefore it can't work as hard for you. So I guess the other glaringly obvious benefit, and possibly the reason that we're hosting the webinar and a lot of the work that we do for clients, is looking at how they can potentially mitigate inheritance tax. So we know that in the UK at the moment, inheritance tax is charged at 40%. And so if you leave it until you die and it's passed down in your will, it could well be that the amount that you pass down has been subject to 40% inheritance tax. And that can obviously have an incredibly material impact on the long-term value of your legacy that you're leaving behind. And one thing you just touched on earlier, well, you said, well, are there any big lifetime events or key points when these sorts of conversations crop up? And I suppose one thing that we found is that sometimes when one receives an inheritance, and especially if this is received at the slightly later stage in life, so I'm talking here that maybe people receive a legacy in their 60s or 70s, one thing that they might consider doing is actually, rather than taking it on themselves and bringing it into their estate because they don't have any great need for it themselves, they might look to enact a deed of variation to the will, and therefore allow it to skip a generation, thus avoiding the 7-year rule that could potentially otherwise apply. So that is one key life event that we see quite often when people are receiving inheritances or legacies at a later stage. They maybe don't need it so much, and that gives rise to a conversation that we're having with them about, well, do they need it? How can it work best for their broader family? And you do have, I believe I'm right saying, a 2-year period post the death to be able to apply the deed of variation. So you do have a little bit of time on your side to make those changes, to have the important conversations with the family or ourselves as planners to make sure that it is working as hard as possible for the broader family. And maybe, again, it may be a slightly obvious one, but the power of compounding, I think, can really never be underestimated. I think it was Albert Einstein that once said, compound interest is the 8th wonder of the world. And so really, the earlier that you can pass that money down, avoiding the inheritance tax gives a longer period where it can benefit from compounding and therefore work ever harder for you. So again, I think for me, there's probably 4 or 5 key points as to why it may be appropriate to pass down during your life, because it can bring back some huge rewards to the broader family. So I guess everyone would like to maybe receive more money along the way, but equally, I'd highlight that potentially there are some pitfalls associated with gifting money during your lifetime or at an earlier stage. And so I guess the really obvious one is maybe that we would see a starting point of any conversation about inheritance tax planning is that it is affordable to make those gifts. So for us, a key priority is to ensure that you yourself retain enough money to cover any of your future potential costs. And so I think the statistics will tell us that we're all living longer. And again, it's fairly obvious from the media that care costs are going up at a pretty alarming rate. And so no one knows what the future holds for any of us and how long we may live and what those future costs may be. But we would argue that it is important to ensure that you're retaining enough money to cover any of those potential costs. No one really wants to be a burden on their family, and absolutely no one wants to run out of money when it's needed most and be turfed out of a nursing home or similar. So it does require some careful planning as far as how much you can give away and when you can give it away. And the other thing that unfortunately we've seen in some cases is some incredibly generous parents or grandparents have given away money, and maybe in hindsight, they've given away a little bit too much money to those receiving it at a slightly too young age. And my view is that many of the greatest satisfactions in life often stem from achieving one's personal goals that you've worked hard for and you've eventually achieved. And we've all possibly come across what I consider to be maybe the curse of a trust fund. So people have been given a more significant sum of money at an earlier stage in their life. And in some instances, it can take away from one's drive or the necessity to work in order to sort of supply the necessary funds to survive. And so, in some cases, I would argue that maybe gifting away too much at too early a stage can actually deprive that individual of the drive to achieve, and in some cases, can cause them to miss out on some of the satisfactions associated with that personal success and achieving what they'd set out to do during their life, whether that's work or other ambitions that they may have. And maybe a final point there is just that actually receiving money on the surface is always something that's an incredibly nice thing to have, but equally it does come with a responsibility, and so for some people that can be a pressure. It can be stress associated with how best to look after that money. And so I think the old adage that money doesn't always bring happiness is true. And so for me, one's got to be a little bit careful about gifting, and how much one gifts and when it gifts and what impact it may have on the individual who's actually taking receipt of those monies.
Yeah, I think you've touched on quite a number of points there that I think we'll expand on as we go through the webinar. But timing, it sounds like, is everything with it, as it is with most things, but particularly when it comes to gifting and leaving a legacy. We're going to expand on a few of the points Peter's raised there as we go through the webinar, including what a deed of variation is. But if you've got questions on the way through, please do use the Q&A function, which is at the bottom, and we will try to get around to as many of those as we usually do at the end of the webinar. Well, Peter, thank you for that sort of intro. And I guess that leads us on to, how does an individual know when it is the right time for them to start gifting? How do they balance up these family dynamics with the potential costs for themselves in later life? Can they pass a legacy straight on from their parents to their children? So James, but as a planner, you're working through these situations with a lot of families on a regular basis. How do you approach this with them? How does someone know when to get started?
It's a good question. It's difficult to know when to get started, is the truth. And how does one know when it's the right time? Actually, it formulates what I think is sort of a larger equation, which is in two parts. One looks at it from the financial considerations, which is the first part, but also the emotional considerations, which is the second part. So when I'm thinking about the financial considerations and what I always discuss with clients about what they have to think about, the first element, of course, is affordability. Is it actually affordable to carry out some form of gifting in one's lifetime, leaving a legacy in your lifetime? Is it affordable? And part of that consideration is actually long-term care costs. Is there going to be enough capital left in the pot to cover the potential for long-term care costs later in life? So affordability is a major part of the equation when one's thinking about, is now the right time? The other elements from a financial perspective is sustainability of income. So by that, I mean, if you're gifting away certain assets, such as a buy-to-let property or part of one's investment portfolio that's providing an income, how does that affect one's income in retirement and for the rest of one's life? Do you have enough income being produced by these assets to cover your expenditure needs? So is it being detrimental by gifting certain assets away that are actually covering your expenditure needs? So that's another element. And then lastly, not creating tax elsewhere, because if you gift certain assets, that could give rise to tax, be it capital gains tax, stamp duty if you're gifting properties with mortgages and so on. So there are considerations from the financial side that really need to be thought about. The second part of the equation, of course, is the emotional considerations. So who do you want to benefit? Is it children or grandchildren? How do you want them to benefit? Again, that's a very important consideration, because it could be quite simple. It could be used to buy a house. It could be to pay for school fees. But if it's for their own future, actually, this is somewhere where we quite like to get involved with families and clients and their wider families to look at actually how they're potentially going to use that legacy themselves. And that leads into tax efficiency, using pensions for themselves, using ISA allowances, making sure they're investing their capital for their future and their children's future as tax efficiently as possible. So how is a really important consideration. And then, as Peter touched on, actually gifting responsibly. It is an important point. What are the implications of this gift of leaving a legacy to a beneficiary? What happens if they receive it at such a young age? Is there some sort of protective element that needs to be thrown around that legacy, such as a discretionary trust, to protect it? And there may be certain complications with certain beneficiaries in their lives that need to be thought about. So that protective element is quite important. So that's the equation I tend to look at when I'm discussing it's now the right time for clients. And it's difficult to put that into perspective, but we find we use something called cash flow modeling. And we essentially use a software where we input certain information from a client's circumstances and their financial situation. We use certain inputs for growth and their assets, their income, their expenditure, debts, liability, including long-term care costs, I should say as well. That's an important element of the cash flow planning. But the assumptions are for inflation, growth on cash and investments. And we find actually it provides real perspective on what's possible. But what's really important with these cash flows is doing it on a cautious basis. That I think is really, really important. Having it done on a cautious basis should allow clients to have some feeling of comfort that actually looking at it, there may be a potential chance that actually leaving a legacy in one's lifetime is potentially viable. And that is something I think we find clients get a lot of benefit from using the cash flow models to see what is possible. But the perspective is, again, it's the more the financial side that you get the perspective. It's the affordability, it's the sustainability of income, and it's the not creating tax elsewhere. These projections can be very bespoke to clients. We can put in all sorts of inputs, and we can look at future one-off costs for property or buying cars. That's all included. So hopefully you're looking at answering that financial element via the cash flows, again, cautiously, to provide some perspective of what is feasible, what is affordable, is now the right time. The second part, of course, when I say the emotional side, it is just looking at, that's the part where the additional planning comes in. So when we're structuring the plan, what are the solution one uses? We can show that via the cash flows. But the second part is really down to conversations with the client themselves. So who do they want to benefit? How are they going to want to benefit? How are they going to leave that legacy? What are their wishes? And the responsibility part is another part of that solution. So as I said, when it comes to when's the right time, is now the right time. It's an equation, but we can help with that first part on the financial side, and we can have those discussions on the second part to find the right solutions, the right strategies, and working out if now is feasible.
So quite a lot to think about coming into that. And I guess the best thing to do when you're getting started is to have a conversation, whether that be as a family or with a professional advisor. And that, I guess that leads us into the next part, which what are really the formalities of beginning to start on an estate plan and leaving a legacy. So, Sarah, perhaps if I can come across to you now and just ask a few pointers, from your experience. You've worked with a lot of clients on making sure they've set up wills on the estate administration side. What are the key bits that everyone needs to start to check off, really, if we're looking at getting started with an estate plan?
Sure. Thanks, Will. So obviously, as James has mentioned, you have got the analytical side and you've also got the emotional side. And in my area, it more deals with the emotional side. And I think one of the most important things is the conversations that you have. So while writing a will is a very individual thing and you are entirely free to decide how you'd like your estate to be divided, it's always best to have a full and frank conversation about your wishes. And whether that's with your family or with a professional, as you've suggested, talking about it will help you to prompt to think about things that you might not otherwise consider. A lot of the time people might think, okay, I want to provide for those who are nearest and dearest to me, but they don't necessarily think about what might happen if all of their close family members were wiped out at the same time. Now, that disaster scenario isn't something that people want to think about, but you should really have a default clause in your will so that if that does happen, then your estate would go to who you would like it to go to. Now, you might have a favourite charity or close friends that you would like to benefit if that were to happen. And without that sort of provision in your will, then the rules of intestacy could kick in, meaning that more distant relatives who you might not have any contact with, they could inherit instead. So conversations help you think about these type of things, and you might discuss it with your family. There might be family charities that you like. And if you do decide to give to charity, not just in the disaster scenario, but by leaving a specific legacy, then the beneficiaries of your estate could benefit from a reduced rate of inheritance tax. So as long as the amount that you're gifting to registered charities is 10% or more of your net estate, then IHT would be calculated at 36% rather than the standard 40%. So everybody can benefit there. You're doing good for charities, and also your family would then be paying less tax. So going back to the conversations, there's other reasons to talk to your family, and you don't necessarily have to go into specifics with them at that stage, but you might find that where one or more of the next generation have no requirement for a large inheritance, as Peter suggested, it would be more suitable to skip a generation and name grandchildren in your will instead. So in simple terms, if you've got somebody in their 80s or their 90s who's looking at their affairs, maybe thinking about rewriting their will, their children might be aged between 60 and 70. Now, they could be retired or thinking about retiring. They might be mortgage free and have some savings. And if they inherit from their parents now, that's just going to increase the size of their own estate, potentially meaning that they'll become accessible to inheritance tax, or increasing the amount of tax that their estate would otherwise suffer. And we have seen on the estate side of things, as life expectancy increases, we have seen a lot more instances of deeds of variation being prepared effectively to pass assets down. So as well as looking at your will, when you're getting everything in order to make sure that you can leave this good legacy, you should make sure that everything else is in order as well. So making sure that you've got an expression of wish form for those assets that aren't covered by your will. So pensions, death in service payments, and also look to see if you've got lasting powers of attorney in place. This is something often while people are fit and healthy, they don't feel that they need them, but you really shouldn't take the risk of waiting, because if your health does fail, filling in paperwork will be the last thing on your mind, and the registration process is still taking many, many weeks, so it can put families in a difficult position. So when thinking about wills and LPAs, you should consider how easy or difficult it would be for your attorneys or your executors to access all of the information that they would need. Would they need to plough through drawers of papers to find essential documents? Have you got rid of important paperwork? Do you have online accounts that someone else would have difficulty logging onto? So it's a good idea to have a summary somewhere of all of your asset providers, insurers, memberships, and so on, because that can ease the burden on your family, who would in all likelihood be going through a difficult time if they're at a point when they need to access your personal information. So as well as keeping a manual list with all the relevant contact details, there are some software solutions available that can record all this for you. So once you've got everything in place, make sure that you review it regularly and update it each time your circumstances change and whenever your family's circumstances change. And then once you've established during your conversations where you would like your estate to go and who you would want to deal with it for you, you can then start planning whether you should leave everything until after you've died, or whether estate planning now would be a good idea.
Perfect. Thank you, Sarah. It's a really useful summary of what individuals need to be thinking about, and some of the things that I think individuals perhaps overlook. Everyone tends to plan on the best case scenario and tends to not want to focus on the worst case scenarios like a disaster clause. For those who are getting started with estate planning during their lifetime, obviously a lot of the things Sarah's just touched on there for those who are planning for what happens after they die. But when you're looking at what to do during your lifetime, James, perhaps you could give us an overview of some of the options you've got available as an individual during your lifetime.
Of course, I mean, there are a number of options naturally, and what I always say with clients, it becomes down to that discussing the pros and cons of each of the options and finding what really works for each client, what actually meets the objective that they have planned for that legacy, because there are a lot of options, and some are more complex, some are more simple, some are more expensive, and so one's got to look at it and see what is the right route to navigate for clients when it comes to leaving a legacy in their lifetimes, because as I said, there's a wide-ranging number of solutions they can look at utilizing. So, we start with the most simplest form, really gifting. And gifting can take the form of what we call potentially exempt transfer, a gift from myself to be it my children or an individual to whoever it may be, for any sum of money. Now that is very simple. A 7-year clock applies. After 3 years, taper relief can apply on the IHT liability. So it's very easy, very simple, but there is no control. Once that's been gifted, that's been gifted. You cannot recall that gift in some regards, so it's gone. And one's got to remember that actually, that element of gifting responsibility to the next generation, when is the right time to do that? Other forms of gifts, such as chargeable lifetime transfers, that's essentially a gift into a trust. And that again has the 7-year rule applies, but you're slightly sort of stuck within your nil rate band. So you can't gift really more than your nil rate bands, or you'll receive a sort of higher level of IHT upfront, so 20% on the excess over. And so consideration has to be given to how much of the nil rate bands are still available when you're gifting into trust. One of the most effective forms of gifting, if viable, if possible for clients, is actually gifting out of excess income. And really, that is quite a useful benefit under current legislation, I should say, that allows for clients who maybe have an excess income when you're looking at your expenditure on an annual basis, and there is an excess income there, to gift that excess income as long as certain conditions are met, and it'll be immediately free from one's estate. So I always think that actually things like excess income are very viable and useful ways of actually mitigating inheritance tax and leaving a legacy on an ongoing basis for children, grandchildren, be it into their ISAs, JISAs, and so on. So it can form part of a gifting strategy. And I should say that actually, when one's looking at coming up with a plan and the solutions used, it's not really just one solution one would look at. Actually, you tend to use a number of solutions that dovetail together to try and get the best outcomes for clients. There's also things like gifting allowances, £3,000 a year for large gifts for one individual per year, £250 for small gifts, and there's wedding gifting allowances as well, which are immediately free from one's estate. So try and use them as much as possible. Now, if we're going to get a bit more complex and a bit more sort of, the cost will start to rise. You start looking at things like trusts, and bare trusts are very simple. That's essentially a potentially exempt transfer into a gift into a bare trust for an individual. So that is reasonably simple. But when you start looking at things like discretionary trusts, interest in possession trusts, there are certain trusts that actually the settlor can retain a right to the capital still, such as discounted gift trusts. That's when we get a bit more complex, and that's where the discussions are really important for clients to come in and sit down and understand the implications. There's tax implications, such as the periodic charge every 10 years. So that's when it gets very, much more complex in regards to the planning, the solutions available, and is it the right one? Because yes, they provide an element of control, an element of protection, but there is more complexities. There's tax implications of certain types of trusts. So one's got to be quite careful when actually looking at the solutions, what is the right one. Beyond that, you start looking into the world of things like AIM and BPR. So, relief for investing in certain types of companies that qualify for business relief. And that does apply a certain type of exemption after 2 years. It'll be free from one's estate as long as you still retain it on death. And you can't gift it in one's lifetime. You've got to retain it yourself. So it is useful to getting it out your side your estate after 2 years. But then you're also taking on an element of higher risk for investing in those types of firms. So again, important considerations around how much does one invest in those types of companies that provide business relief, and so one has to really think quite seriously about that and how much one invests. And then actually one of my favorite forms of IHT planning is pensions. It provides various reliefs for clients. The tax relief upfront for putting money in. It has gross roll-up within the fund itself. It's immediately free from one's estate. The pension is outside of one's estate. So, where possible, I think pensions are a very useful source of actually IHT planning, as well as providing additional reliefs to individuals, and should be really utilised as much as possible. So those essentially really are the sort of solutions at a very high level. One can get a lot more granular and detailed about them, but for the sake of this webinar, I think it will take quite a long time to go through them all. So that's just it at a very high level.
Thank you, James. Yeah, a lot of options there and a lot of detail to go into on the pros and cons. So we do have a few questions on them, so we might come back to a couple of them later on already. You touched on one interestingly in there, BPR investments, and this I think probably can link to my next question for you, Peter. As an investment manager, someone who's been running portfolios for a couple of decades now, how should families think about navigating this dynamic of potentially investing across different generations, where you're talking about, at the one hand, potentially wealth preservation, but on the other hand, some of the beneficiaries may be much younger, and wealth accumulation might be their priority.
Absolutely. Well, I think you've hit the nail on the head there. I think there are key differences associated with those different periods in your life. And actually, when you're investing the funds, it's never the case that one size fits all. And we believe that it's essential to put together a truly bespoke plan that delivers on the objectives of that particular individual, whether it's the individual who's looking to mitigate inheritance tax but potentially worries about some costs further down the line for themselves. Therefore, business property relief assets such as investing in AIM or similar might have been appropriate for them, but it absolutely would not be appropriate for someone who's receiving it at a much earlier stage in their lives. So when we're thinking about what is appropriate to invest into for those different individuals, a starting point may be looking at their risk profile. For me, probably one of the most important things is actually one's investment time horizon. It's really, really, really important to understand when one might actually need access to those funds, as that will probably, in our eyes, help determine the most appropriate investment for that individual. And this will vary enormously. I think one of the biggest sins associated with investing is being forced to sell an asset or an investment in inopportune moments. And so careful planning can make sure that you never fall into this trap. And that's something at absolutely the heart of what we're doing when we're working with families, and whether it's for inheritance tax planning or their own investment planning themselves. So, I mean, maybe using the example that James touched on, he was saying, well, habitual gifting out of excess income can be a very, very powerful tool for families. And I would absolutely go along with that. So what we're saying there is, if individuals have a certain pattern of gifting over a period of time, and it comes out of income which is excess to their needs, then it avoids the 7-year rule as far as inheritance tax is concerned. And so for those families, when they're thinking about mitigating inheritance tax, we found it a very valuable tool. And one way that they might look to do that is, say, ISAs, which traditionally they may have invested during their earlier stages in their life for capital growth. They reach a certain stage in their life where they feel maybe they've got enough, and actually there may be some disincentives associated with growing their estate more, because it might push it beyond the 2 million mark, and therefore that may give rise to them reducing some of their personal allowances for inheritance tax. So instead, what they might do is turn the investments on their head in their ISAs and move it to income producing investments. So it could be a portfolio of bonds, it could have access to commercial property, it could have higher yielding shares, or all sorts of higher income producing investments they may choose to put into their ISA, because that would give rise to a greater level of income for themselves. And then in turn, that would allow them to make greater levels of gifts out of their excess income. And you'll note that I picked on the term ISA. So the beauty of that is that they've created a much greater income for themselves, but they haven't actually paid any tax on that income, because it's been generated within the tax-free surrounds of the ISA. So they've generated excess income themselves, tax-free in the ISA. They can then gift that extra income each year on a habitual basis to their beneficiaries, again free from tax. Equally, it's also free from that 7-year rule that people are always talking about. So it can be an incredibly powerful tool, and does have a big impact on how we would recommend they're investing their funds. They've gone from being growth investors and wanting to swell their estate and their assets and their capital, to actually seeing that the real benefits for them at that later stage in life may come from making gifts to the family. Importantly, they're retaining the assets. So the assets are still there in the ISA. If they needed to call upon them, they needed to pay for that long-term care or whatever it was further down the line, but they are also benefiting the family by gifting away the extra income that's being created each year. So at the later stages in life, you may have one particular strategy. At the other end of the spectrum, let's say a grandparent really wanted to kickstart their grandchild on their investment journey. They could contribute to a pension for their grandchild. And even if it was a minor, you can claim tax relief on that pension contribution. Even if that minor was a youngster in education and had no other income, you can still contribute a certain amount to a pension at that early stage and you get tax relief on it. So for that individual, the investment strategy would be completely different, because for a minor who's investing in a pension, they won't be able to touch that for a good number of decades until they're at least 57 years of age under current regulation. And therefore, for them, actually, their investment strategy is focusing on capturing the very best levels of growth. They really want to tie into that power of compounding that we were talking about earlier on over the long term. So that can really impact their long-term retirement plan for themselves. And so for some grandparents, it's a nice feeling just putting away a very modest sum of money into their grandchild or great-grandchild's pension can set them off their savings journey, get them into that way of thinking of saving, seeing the growth that comes through that encourages them to invest further for the future. But the actual investment strategy for that child will be very different. Usually, I'd imagine it'll be focused on capital growth and with a very long-term investment horizon. So as well as looking at all these different investments, as James said, we're looking at different structures and tax wrappers that will be different for different individuals at different points in their life. And as James mentioned, some of the rules have changed, and whereas trusts would be the go-to maybe a few decades ago, a little less popular these days because of the taxation treatment, they certainly do have a role to play in certain cases. And then in addition, James was talking at length about pensions. They're widely used when it comes to inheritance tax planning. Similarly, we've got offshore bonds, family investment companies, and similar, where they can be passed down to next generations, or indeed retained for the time being, but invested for the overall family. So I would argue that one should look at these things very much on a bespoke basis, and part of the beauty is having that conversation with a professional, understanding which each component of the family needs different investment advice, different sorts of appropriate investments for their own requirements.
Thank you, Peter. It sounds like there can be quite a lot going on there, particularly where you're looking at those habitual gifts out of excess income, which probably leads neatly onto how does this all come together? So once you've got a bit of an estate plan going on, you've put some of the documents in place. I mean, Sarah, the one thing we haven't actually touched on yet is what can individuals be doing to make sure this is as easy for their beneficiaries to follow after their death as possible? What's the information they need to have to hand? How are some of the calculations actually done? You've completed returns for individuals on death, and you've been through that process. What does that actually look like for those who potentially might need to go through that for family members, or who might be setting things up themselves for their family members at a later date?
Okay, so that's one of the difficult things. I mean, obviously, we've been speaking about ways of reducing inheritance tax, but we can't escape the fact that there are a lot of estates that still do have to suffer inheritance tax. And we mentioned about good record keeping, but one of the biggest problems for executors is actually paying the IHT. So I'd suggest that as well as keeping everything up to date and making sure that everything still meets your wishes now and your family's wishes, it's a good idea to keep an eye on the valuation of your assets. So whether it's the value of your family home, savings accounts, share portfolios, cars, valuables such as paintings or antiques, because these are all taken into consideration when working out the value of your estate for IHT purposes. So remember that gifts between spouses are not assessable to IHT, and neither are gifts to charity. Obviously, we mentioned charitable legacies in your will, but you can also make gifts to charity during your lifetime. And if you create a charitable trust, unlike any other sort of trust, there isn't an immediate charge to IHT. So a charitable trust can create a legacy that continues well after your death, and gifts into that can be made tax-free. So as I mentioned, that it's the responsibility of your executors to pay inheritance tax if it's due, and they've got to find the money to pay that tax before they're able to apply for probate, which is needed before they can gain access to any of the assets. And while most banks are part of the direct payment scheme, which means that they'll release funds to pay HMRC directly, but where there's no liquidity in your estate, if it's mostly made up of property or artwork, for example, then things can become very difficult for them. So you might want to consider during your lifetime whether you need to take out a special whole of life insurance policy that pays out when you die, just making sure that the cover would be enough to pay any inheritance tax that might be due. And you're only going to know that if you keep an eye on the value of everything. But as far as IHT is concerned, broadly speaking, it's calculated by adding together the value of all of your assets, and that includes all of those that held jointly and beneficial interests in some types of trust. Plus, you have to bring in any gifts that were made in excess of the various allowances in the previous 7 years. You then deduct debts such as outstanding mortgages, and that includes equity release mortgages, credit cards and loans, and that gives you your net estate. You then take off your nil rate band and your residence nil rate band if it's relevant. And remember that if you have been widowed, you will have any of your late spouse's unused nil rate bands as well. And then anything over the nil rate bands will be assessed to inheritance tax. And it's not until then that you deduct any available reliefs. As James was mentioning, business relief on certain assets, that wouldn't be taken off until after you've done the other bit of the calculation. And then the worst bit is the fact that the tax must be paid by the end of the 6th month after the date of death, and interest accrues after that. And HMRC's current rate is a whopping 7.5%. There is more lenience on IHT due on property and other assets that are more difficult to sell. So you can pay that in instalments, but it does still attract interest. So your executors would need to bear that in mind, especially as interest rates are so high. So they'd need to work out whether that is in fact actually beneficial to pay in instalments or not.
Thank you, Sarah. Not a simple process, especially given that a lot of individuals who go through that executorship process are probably going through it at a difficult time for themselves personally, and maybe coming from a background where they don't have any professional insight into that. So I think it's really important for all individuals when they're looking at setting up an estate plan that they make it as easy as possible for their beneficiaries and their executors to understand what has been going on historically. One of the key ways to do that is obviously to have documentation and to keep things under regular review. And maybe it'd be good just to run through the three of you quickly and just sort of talk through what are the bits that need to be reviewed. What do each of you see as the priority for being reviewed? Coming at it from three different angles here, I think you're going to have three different answers. But James, why don't I start with you? What are you reviewing? How regularly should someone be reviewing it? Talk to me about your side on the planning piece.
Yeah, I think it's been touched upon already during the webinar, but the bit I always think about when it comes to making sure one's sort of reviewing it regularly is essentially making sure we talked about the effects of compounding when it's gifted, but actually the effects of compounding on an estate can be equally as important to review, because assets of an estate, if it compounds, you've got the residential nil rate band. If the assets go north of 2 million, you start losing that exemption. And so I always think actually reviewing where the estate is on an ongoing basis, and it links back to the gifts and excess income and how that could help, if that's applicable, in keeping the estate in the position where it's around 2 million or beneath to maintain the residential nil rate band. The other important element, of course, is changes to legislation. We have the budget coming up on the 30th of October. There's lots in the papers and press about what potential changes could be there. We can see that IHT has been under review for quite a long time, and inheritance tax will, I think, remain under review depending on who's in power and when. But just that element of changes to tax and legislation is very important, and that's why the ongoing review of one's estate, I think, is important on an annual basis.
Yeah, I would agree with you there. Annual is probably the key part of that. There's once we pass through this latest budget, we're expecting to have at least one budget a year moving forward. So there's an opportunity for legislation to change there. And that's going to impact directly on other areas as well, including potentially portfolios and the economy as a whole. So Peter, when you're looking at reviewing this sort of scenario for clients, how often are you checking in, and what are you keeping a keen eye on?
Yeah, I think, as you say, that the global macro picture is changing the whole time, and that is our role, keeping abreast of what's going on and making sure portfolios are tailored to what the external environment is. But I think there's a couple of other key points there. That one that maybe Sarah was touching on, as one's at much later stages in life, it may be no one knows what's around the corner and when the proverbial bus may come along, and it may be that some of those assets are needed to pay inheritance tax very soon after death, and therefore that raises the question, well, I said earlier on, one of the real sort of cardinal sins associated with investing is being forced to sell an asset at the wrong time in the cycle at a low level. And therefore, it may be appropriate to have that conversation. So maybe the portfolio should be moved into much more liquid, less volatile, less risky assets at that later stage, so that they are accessible. A property might not be so liquid at that point when the inheritance tax needs to be paid. So perhaps at the later stage, de-risking the portfolio, investing in shorter dated gilts or whatever it may be, so that you are ready should they need to be encashed at any time, and then not having to worry about the market developments or the movements that are going on around you. So I think in the same way as James was saying, these things need to be reviewed periodically, at least a year. I would argue the same for the investment strategy. You've got to be looking at investment markets day by day or week by week to assess the macroeconomic picture, but actually looking at your personal circumstances, at how they're developing and what your potential needs for those assets may be further down the line. That will drive some of the investment strategy decisions which we're making as well.
So we've got annual, and can we make it 3 from 3? Sarah, what needs to be review and how often?
I almost agree. I do agree with very regularly, but I would have it more as an emotional response to what's happening in your own life and what's happening in your family's life. So whenever your circumstances change, look to see if you need to make any changes, but also as your family circumstances change, they might be getting older, they might get married, they might then get divorced. So you might want to make a change to how things are left to them. They might have become financially secure, and as we mentioned before, skipping generations, but also when changes happen to legislation. So your own personal changes, legislative changes, and your family's circumstances changing.
Perfect. So not quite 3 from 3, but pretty close. Pretty close. So that probably brings to an end, I guess, the more formal element of this evening. We are going to move on to a Q&A shortly for everyone who's been posting questions. So if you are able to stay with us, please do. If you've got questions, please continue to submit them. Ahead of that, obviously, I'd like to thank all my panelists joining me so far. One of the things we're also going to do now is put a quick question up on screen. If you have been interested in any of the content discussed today, and if you would specifically like to speak to an advisor here at Killick & Co about your circumstances and how anything we discussed may be applicable directly to you, as we get into the Q&A, we'll try to answer as many questions as we can, but where it starts to get a little specific on any one individual circumstances, that's where it's best handled by a direct conversation. So we can arrange for that for you. It's not a problem. If you do tick yes on the question, we'll get someone to reach out to you in the coming days to start that conversation and take things forward from there. Obviously, that's a no obligation initial conversation. It's very much just an opportunity for you to ask questions and see how things go. I'll leave that on screen for just a little bit longer because we've still got answers coming through. But perhaps I can get started with one question whilst that's still on there a little bit longer. Yeah, still getting answers through. So we've touched on a few of these already, but I'll ask them anyway because we can move through them quite quickly if we've already had questions. The first one has come in, and Sarah, perhaps I'll direct this first one in your direction, which is, are there any tax implications of gifting during a lifetime, assuming that you do live for 7 years? And what would be the benefits of setting up a trust for children and grandchildren?
Okay, well, if you make an outright gift, then it's a potentially exempt transfer. And if you survive for 7 years, that will fall outside your estate and there will be no IHT implications. But if you create a trust, gifts into trust are immediately chargeable to inheritance tax. So you can put an amount in that's equivalent to the nil rate band. And then you've got this rolling 7 years where you have to wait 7 years before you can make further gifts into the trust. So you can either do outright gift, survive for 7 years, or put it into a trust now and have an immediate charge to inheritance tax if it's over 325.
Perfect. Thank you. Nice and succinct. The second question we've got is relating slightly to IHT, but otherwise to business relief assets. Peter and James, maybe this is going to be a joint question for the two of you in that case. If business relief is abolished in the budget, will there be time to restructure investments afterwards? Will the change only be effective after the current IHT legislation has been amended? And if not, would it be sensible to accelerate gifts of business relief qualifying assets? I don't know if James or Peter, you want to go first. Well, James, do you want to kick us off?
I mean, it's difficult to really know where they're going to go with the sort of changes to IHT legislation in the budget. There is lots in the papers, there's lots in the press. I think if you just take a step back and cut out the noise, then maybe business relief is one of the areas that they may look to reform or change. But then that has implications on the wider AIM market, the companies that benefit from this type of investment, and maybe go slightly against the growth agenda. So I think one's got to sort of really look at it logically and think, are they going to abolish it? Are they going to change it? How is that going to work? And when will the changes come into effect is another unknown, really. Will it be immediate, or will it be by the next tax year? So I think it's very difficult to tell what that may look like, or what may happen, essentially. I wouldn't, when I come to looking at investing in business relief, business property relief type assets, I'll go back to the point I made earlier, which is there is a higher element of risk there when you're investing in these types of companies. And as such, it can, you could be creating more risk by accelerating gifts into there. And, it's a more volatile market. There's probably less liquidity in some of those companies as well. So I think one's got to be quite careful if you're thinking about accelerating gifts to an asset class which is higher risk. So that would be my response.
Peter, I don't know if you had anything to add on that.
Yeah, I certainly, I think this close to the budget and with so much uncertainty, you're not going to find me going one way or the other as to whether they will get away with BPR or not. I think the point I would make is, and there's been a lot in the press about how this is just a tax relief that the very wealthy use to avoid inheritance tax. But I think there is also quite a strong counter argument there. They did go through the patient capital review, the previous government, and they looked into whether it was still appropriate to retain these tax reliefs. And they came back saying, well, actually, we do need to incentivize via tax reliefs people to invest in generally earlier stage companies or riskier businesses, because we won't have the big companies of tomorrow unless we have those growing smaller companies. And that the only way to get those smaller companies growing is to get some investment into them. And the only way to get the investment into them is to provide some form of tax relief. So certainly none of us know what's going to be in, well, I don't think many of us know what's going to be in the budget, but I don't think it's a clean sweep that they would definitely do away with business property relief, because I think these politicians, they don't want to be the next Liz Truss who goes down famously for bringing down the markets or making some sort of disastrous decisions. And there are those out there. So look, if they did away with business property relief on AIM shares, it could have a very detrimental impact on the AIM market, because those people who are in it for the inheritance tax relief may come on to sell those investments, thus depressing the price. And with the Labour Party, want to necessarily be the ones that really sabotage the AIM market just at a time when their agenda is saying, well, we need to grow our way out of the problems that we've got. So as James rightly says, it's very difficult to predict what they might change and when they may bring it in. But I think there is a balance to both sides of why these tax reliefs were in place in the first instance. And so it won't be completely straightforward for them to abolish it immediately.
Thank you. I would agree with that statement wholeheartedly. There's a reason for them in the first instance. So getting away with them is not going to be That's quite so simple. While we're on business assets, a slightly more specific question, Sarah, perhaps one for you. If someone is a sole trader business which owns a property that is part of the business, does this fall in the scope of business relief? Is that a clear cut yes, no, or is it going to depend on other outcomes?
It might depend on other outcomes. So obviously, business assets that we've spoken about today are unquoted shares, and AIM assets count as unquoted shares in that respect. But other business assets would be assets of a business, but the business would have to fulfil several qualifying criteria for its own assets to qualify. So we can provide a list. I think we usually send a follow-up email after the webinar is finished, because we don't want to go into too much individual detail, but we could provide a list of the qualifying criteria for business assets in that email.
Thank you. I think the person who asked that question will probably appreciate that. We could follow up with that, as you say. And then we've had lots and lots of questions on gifts out of regular income. How do you define the excess income? Do capital gains included in that income? So James, perhaps I can jump over to you. How do you define excess income, specifically looking at ISAs and SIP drawdown here? And then just to add into that question, can you include capital gains within that regular excess income?
So to start with, I'll answer the capital gains element, which is no, you can't include that in, sadly. It's got to be from income producing assets. So essentially ISAs, income from there. The SIP, yes, because it's income from the SIP and it's actually taxable as well. And so those sort of, that's where they will be looking at an excess income. So excess income is essentially income that is generated by interest and within the ISAs, and essentially is the income that you have over and above what your expenditure is in any one certain year. That's the excess income element, but capital gains is not included.
Perfect. Thank you. We have had some other questions on CGT, and I know that wasn't the topic for today, but Sarah, I'll just ask you perhaps on your view on if CGT is increased in the budget, do you have a view on when that is likely to be effective? Is that likely to be immediately, or is that likely to be next tax year? We've even got a question asking whether there's any risk that transactions completed in this tax year but before the budget could be impacted. So I don't know what your view is on that.
I would very much hope it's in the next tax year. There have been in-year changes in the past, but I don't think that's happened since the early 90s. And there is always widespread criticism when that happens, because it makes it really difficult for tax agents. I have never experienced legislation being applied retrospectively to transactions that have already happened. And I think that the problem with if you make changes and say, okay, these are effective immediately, or they're going to be effective in the next couple of weeks, it can cause too much activity in markets and just cause problems. So I think that they would have enough foresight to consider that, and the impact it has on HMRC, who would have to get guidance written immediately, and they're not necessarily quick to provide guidance as things are on tax agents as well as on individuals. So I would very much hope that it would be after the start of the new tax year.
Perfect, thank you. And I'm just looking at the time, we're nearly at 6 o'clock, so I'll probably go with one last question, and then we'll look to try and wrap things up. We have had a few questions on this, so James, perhaps you could give us a little bit more guidance on what are some estimates that we might use for long-term care costs. I've got the question coming from someone who's a healthy 60-year-old at this stage. They're looking quite a long way out. They're not sure what that might cost. What are we looking at today, and then how can we forecast that forward?
I mean, I would say that naturally, wherever one is in the country, those costs will change. The South East and London tend to be more expensive than other areas, but we tend to use in our projections the national averages. So, and we look at long-term care over sort of 5 years, with essentially 3 years residential care, where the costs would be sort of around 52,000 a year, so £1,000 a week. And then for nursing care, which is 2 years of the 5 years, we look at £78,000 per annum. So I would also add that we also increase those costs at around 5%. So we do put a higher rate of inflation for long-term care costs as well.
Perfect. I'm aware we've had lots of other questions. Unfortunately, we don't always get around to answering them live on the call. But what I will say is that any questions that are unanswered, and in fact those that we have already answered, we will look to answer them directly to the individuals who have submitted them. So we should, I think, we collect email addresses as part of the sign-up process, which allows us to come back to you. If we don't, and you had a question specifically that you still want answered, you can email info@killick.com. Otherwise, I would like to thank everyone for their time this evening, particularly my 3 panelists, Peter, James, and Sarah. A recording and follow-up for this webinar will be sent out later this week. And so if there are any questions off the back of that, please do come back to us directly. Or speak to your advisor if you have one. Thank you, everyone, for your time, and we will see you again, hopefully in the future.